How's it going, ladies and gentlemen? JT here for episode 136 of the Doots podcast. Ding, 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 ding. This is a special edition. We've never done a special edition. I'm feeling special. You're feeling special. All my overlays are messed up. Thanks to it. Logri popped in with this. Let me fix these overlays. That's so much better. Okay, good. Good to have everybody here. Tune in on X, YouTube. We're actually on the stage on Discord as well. If you're joining the stage on Discord, you're going to want to watch the streaming video and listen in on that because that is where our Zoom call is being held. And we're stupid delighted today to have Erica Khalili from Lead Bank here. Erica, welcome to the show.
I am beyond pumped to be here to talk all things digital assets, banking, and maybe even just a little bit of barbecue.
Very good. I learned literally 2 hours ago that Lead Bank is in my backyard here in Kansas City. I will say they are on the Kansas City, Missouri side. And when you're talking about Missouri versus Kansas City, Kansas, the people on the Kansas side, we just let them have it. It's okay. It's okay. You still have the Chiefs and the Royals for now. But you don't have a Buc-ee's coming. We do on the Kansas side. So welcome and thank you. And I realize that you're actually from out of state, but you are in town for business. And yep. I wish I would have known that because I would have had you come to the studio. We could have done this live, but that's okay. This is easy too. I'm sure you got a lot of work ahead of you. We got you until the 2 o'clock Central Hour, 3 o'clock Eastern. So let's dive right in. You're into banking and crypto and marrying these two things together, but I always like to get the origin story. It's not really when did you first hear about Bitcoin, but before that, what were you doing outside of the blockchain space and why was the blockchain space eventually a natural fit for you? Thank you.
Yeah. So I started my career. I'm a lawyer by training. Before I became the chief legal and risk officer, which is my fancy bank title here at Lead. I spent the first decade of my career on Wall Street and I watched, the evolution of technology in terms of, listen, I'm going to date myself here a little bit and I might be older than a few of the listeners, but I was delivering like physical paper securities to like investment bank pages in my formative years.
Oh, wow.
And so I know. And then I got recruited into tech by the team over at Square when it was still Square pre-block. And I remember what really motivated me to make the change was the ability to use technology to sort of open the aperture of financial services to people that have been left out, to find efficiencies, to drive innovation. Because again, Square started with like the notion that we're all carrying around these computers. Why can't we take credit card payments? Now it's the behemoth of Cash App and everything else that they're doing. But when you think about the problems to be solved, that was kind of what motivated me. Now, I'll be honest, I was a blockchain skeptic for a very long time. I think I coined the phrase that was like, crypto is a solution in search of a problem for a very long time. But working super closely at Square and seeing how Bitcoin sort of could equalize a lot of international commerce, be the currency of the internet, and then watching that evolve into stables. For a long time, I think people thought we were, as a public company, like, why is Square so interested in digital assets? Why are they trying to build a bank? Why are they trying to marry these concepts that can seem really, really far apart? And my point of view was always, we need to make commerce easier. We need to make global money movement easier. We need to make things that right now are expensive, slow, antiquated, and a bad experience better. And here's a way to do it. And then moving on to this journey, I'd been on the operator side and I asked a lot of people, like, do you love working with your banking partners? And the answer was always, they're fine. Yeah, exactly. So our thesis when we founded Lead about 4 years ago was, why couldn't we be the banking partner that was viewed as an asset, not an albatross? Why couldn't we be the bank that people saw as willing to engage in things and really evolve with our partners? And we see this world now, and with where we're seeing the regulatory climate, and I'm sure we'll dig deeper into that, where the role between US regulated financial institutions, digital assets exchanges, and all the various folks in between are going to have to harmonize and marry in order to actually find the way to make digital assets interoperable and really take advantage of what the blockchain technology can be used for. And I started in structured products, so I'm always talking to people about tokenization as a tool, like tokenization of assets, how to avoid double pledging, how to have a single immutable source on the chain that represents a loan I purchased from a fintech platform or a participation, or even in traditional community banking, the syndication of a loan, putting that on chain, you take the antiquated way of saying, did the loan servicer mark their books and records that I bought this asset?
Mm.
And you have a single source of truth. So there's so many things in the industry that excite me. And I'm really, really pumped about being able to be here today, talk about them, but also I'm seeing a world where when we first acquired in 2022, again, we're the ladies who bought a bank to work with fintechs and digital assets partners, and it was a very different time. And I'm sure a lot of people thought, like, what are those people doing? But we're being very open and said there's always been a way to do this in a compliant manner. We continue to engage and we continue to try to celebrate the good actors in the space that are finding real sensible solutions and having a compliance first mindset to what they're building. And so that's how I got here. I wouldn't say I'm fully on the other side where I think everything's going on chain. But I think that we need a lot of people in the traditional financial institution space to lean into this, to learn, and to really see what the future is going to look like. And so that's how I got invited here. And so I'm super excited to chat more about it.
I want to give a total credit to LogrisTheBard from tokenomicsexplained.com for helping to bring Erica right out of my backyard onto the podcast. I'm sure now just talking to you and knowing that you're here, I think it'd be fun to visit the bank where you're at. If you want to check out Lead Bank, it's lead.bank. Just type that in your browser and start poking around. Caitlin,
I want to talk with her about basically there's a lot of things that we hear, terms that we hear in the crypto industry that are kind of they become technobabble, and we don't really get into the base of them, right? So we'll hear things like tokenized bank deposits, we'll hear things like stable coin, and we'll hear things like what's a registered bank, does that mean? And also just over my lifetime, the role of a bank, at least in my life, has gradually been diminishing. So I've had a Wells Fargo account for, like 30 years, right? Again, we're old. But I used to have a lot of checking activity on there and debit cards, and I go to the ATM and have a lot of withdrawals and whatnot. And more over my life, it's been like, well, I still have a checking account because sometimes I'll need to write a check to a landlord or something, or some family will send me money over Zelle or something, right? That's relatively minimal. But the amount of activity I get on a statement is like 3 or 4 lines a month now, where it used to be like 100, right? So the role of a bank, at least in my life, is diminishing. And so one question I'd have for you is, at what point do we still need, or we don't need, checking or savings accounts from a bank? Or now I have a Fidelity brokerage and I have an ACH, account number and a routing number there, so I can basically accept direct deposit there. And the money goes into a money market backed by T-bills as opposed to into a checking account where they lend it out and give me, 0.5% or 0%. Now I'm making full Fed T-bill rates. What is the role of banks going forward, as we get that flight of capital out to money markets and as we get brokerages that offer equivalent services to what a checking account used to be essential for?
So there's a lot to unpack in that. So I'm going to kind of take it in a few parts. I think that although the traditional banking rails have shifted as we've seen more things go on chain, more into money markets, et cetera, there is still a large cohort that relies heavily on traditional banking infrastructure. And you talked a little bit, and one of the things I've been chatting about a lot in VC is you talked a lot about, these funds leaving traditional sort of community banks. And with that depository flight that I think everyone is chatting about, well, probably not everyone listening to this maybe is chatting about in connection with the pending legislation, you still see the need for banks. You see the need for banks to make loans that other people aren't making. Who's making agricultural loans? Who's making the small business loans here in Kansas City, Missouri? That's a market that's not being served by those huge behemoth institutions. And so with the potential for deposit flight, you do see the US banking system that could potentially be in peril. That being said, I think what's important to notice here is that there has to be a way where you marry those two concepts of sort of the traditional banking, community services, things that need with innovation. And so I do think that there's a place where you see, and it's come across in all different forms of regulation, where you see smaller banks being incentivized to do these types of things by understanding that for example, reserve management. That's something we've leaned into heavily here for, non-algorithmic stables. And so I think that it's very important to ensure that there is still enough capital and deposit inflow. But I do think we'll see a shift over time. But I do wonder with even how you're doing, you probably have credit cards, you have things like that. When you think about on-chain assets, and I think we're going this way, but to me, I talk a lot about credentialization. Like there's the folks that are dialing in here, but there's my father who's an immigrant who's 80 years old in Illinois who wasn't using remote deposit capture until the pandemic. Like it is an incremental change in user behavior that will take time. The other point that I think is super important is the interoperability point. And so until you can spend directly out of a wallet from a card that's linked to something on chain, or if you're spending out of that Fidelity account, how does that work? And why is it shifting what you keep in different sort of pockets and pools of money? And that's where I think one of the things about FDIC insurance is really important, because again, we're in a place where we haven't seen the unhappy path in some of these use cases and circumstances where what happens in a bank failure. And unfortunately, we've seen some of those in recent years, but you haven't seen when a huge sort of stablecoin issuer potentially went insolvent. And so there is a regime today to protect customers. And I think a lot of this comes into what is your risk tolerance. And different folks have different risk tolerance in terms of where they want to keep their livelihood. And we want to meet customers where they're at. I think the other thing that you mentioned that I thought was super interesting was basically just the why. I think as we look forward, and this is a place where I'll be honest, I think the digital assets industry has done a poor job historically, where there has been a lot of jargon. And I remember the first time I was meeting with a banking regulator and I was talking about digital assets. And they mentioned like, well, if you lose keys, if you lose this, the money's gone. And although I'm in Kansas City, I'm a New Yorker. So I said, yeah. And if I leave my wallet on the 6 train, that money's gone too. Like that's not coming back to me. Let me tell you, so trying to just be that bridge between the two worlds and find that explainability, I think is something that actually will propel the digital assets industry and have broader adoption, but it needs to meet everyone where they're at.
Yeah, I think, risk is going to be a central theme of this conversation. And no doubt there are risks to self-custody, and there are things that we are trying to do at a UX level to improve those risks, right?
Yep.
So I've been a long champion that I think we should be developing not just multi-sig wallets, but policy-based multi-sig wallets. So I can add features like an ATM withdrawal limit to an account. So if the address gets compromised, you got $1,000 from your pocket change from your whatever reasonable expense would be, but like the whole life savings isn't gone, right?
Right.
We had a $1 billion hack by, what was it, BitGo or someone last year? Like literally lost $1 billion off of multisig because they didn't have something as simple as an ATM withdrawal limit, which would have made it trivial to catch that, right? We have risks. And there's different risks. So like if the bank has FDIC insurance, it's basically insuring against the risk of the bank doing underwriting poorly, and they lend out the money, and then there's a systemic default or something happens in the economy that suddenly they say, oh, you can only have 10% interest on credit cards, and all the people with existing credit cards come in that shouldn't have those credit cards because they're high risk, and they start defaulting and that hits the bank, right? So some things that happen that can cause a bank to fall out, not even the bank's fault necessarily, just environmental factors, but then the government agrees to step in and basically insure those deposits, and that's FDIC insurance. But if you're holding a T-bill or a tokenized T-bill and, a trust like PayPal has their stablecoin, the PiUSD stablecoin, right? You're not just a general creditor. You're not just in line in bankruptcy proceedings. Like these are basically bearer assets to a trust that holds the underlying T-bill. In which case, if the government would default on the T-bill, what's the chance that they wouldn't default on the FDIC insurance, right? These are kind of similar risks, right? Either way, it's the government backing it. And if they decide to default on a huge number of borrowers or deposits, either way, it seems like you're basically trusting kind of the same entity, the U.S. government, to honor its word and to backstop those things. So what is the difference between, did I capture it roughly? Like, is there a major difference in risk between having a stable coin that's backed by a treasury bill, that is in a trust like PayPal, versus something that is in Fidelity in a money market, which is, again, backed by a T-bill?
I think that to me, I think we haven't tested it. So, like right now, I think we're all speculating and hypothesizing. We can tell you what happens in a bank failure, whether that's from poor lending practices, a market run, which maybe isn't, and it's not just lending it out, it's also making investments and really, really thoughtful liquidity management. I think the difference is when you look about at FDIC insurance, the FDIC is by definition an insurance agency, meaning that it has been promulgated to manage risk and it's managing the risk of the folks that are in its system, those of us that have FDIC insurance. So there actually is a regulatory obligation for me as the owner of a bank that I have to stress test. I have to look at downside protection. I have to look at market movements. I have to have an orderly wind down plan. I don't actually, because we're not large enough, but like banks do. That's not necessarily true for some of the other entities. So I think, again, when you look at it through macroeconomic cycles, and yes, if everything is fully backed by T-bills, it should be, in my mind, a non-materially different risk, but it's never been tested. Also, the issuer of that coin that is backed, it's not that the coin Erica owns specifically one-to-one matches to a T-bill. It's on a pooled basis. So although there should be sufficient funds, the question is, what if there aren't? What if something has gone wrong? Who's testing the logic there? And also, in those situations, if there isn't enough, how does that get distributed when all of these are net new? And I think that what we're seeing now, and for those who've been following in DC, we're seeing the government via Genius, via market structure, actually looking to set the framework, which I think is a great step forward to give regulatory clarity, which will help for credentialization of exactly what you're talking about. It's just an evolution. And then the question is, how do we balance this innovation with not compromising the US financial system? I think there has to be a balance between the two, because is it really in the best interest of the US banking system and the US economy for all consumer deposits to be sucked out and put into a Fidelity or a BlackRock or one of those versus being at local banks to support the economy holistically?
Well, is it okay? So that raises a kind of like nanny state issue that you're poking out of. What's in the best interest of the U.S. economy might be different than what's in the best interest of the individual depositor. If the individual depositor gets an extra 1% of their interest, who are you to manipulate the rules to force them or to to somehow compel them financially otherwise to deposit to a bank instead of a higher yield system, right?
So I think, unfortunately, or fortunately in my mind, that's the argument against any consumer protection law is, does that make the paternalistic oversight of the regulators too strong? And I think that's a bigger question of whether or not we're right sizing the regulation for what it should be. But I do think there is a duty to protect customers as well. That's something that's ingrained in our system holistically and why we have, any regulation at all. And so I think that's a little bit what you're pulling on, if I'm understanding you correctly.
Yeah. When you say protection, and I was saying nanny state, that's basically the direction I was going. Is like I have a hard time taking those arguments in good faith. Maybe that's just a sort of libertarian bent I have. But saying like, oh well, if the banks are gone, then who's going to make these other loans over there? And I can think of ways that we could do this through the chain, right? That we could have an underwriter that has an account with reputation, that people could look at the history of the underwriter and like give loans to him that he will pass out, like in the same way if I approach a venture capital firm, right? I give them money, I'm an LP, they go and find investment, and then we're hoping for a return on it, right? And I could look at the long-term history of the people in that fund to decide which fund I think is making smarter investments and underwriting those risks better. So we could imagine a decentralized system on chain where we've seen attempts at this at protocols like Melonport, for example, where you have a market of these different underwriters that have these on-chain behaviors, and you can kind of assess which of them meets your risk framework and has the returns and is managing the risk, according to your wishes, right? In accordance with your where you are in life and your goals, right?
I think my challenge with that, just to be blunt, is like, well, then why? It's the exact same argument of why we wouldn't have securities laws and why certain things that are highly complex investments should only be marketed to accredited or qualified institutional buyers versus retail investors. Like we've seen through what happened in, and I'm going to date myself, like 2007, 2008, as well as recent things, that there is a level of consumer protection that I think is appropriate. And I do worry a little bit, to your your point that if we go completely on chain and we don't have that same regulatory framework on what could be considered a highly speculative investment, retail investors could be really, really harmed. And I think that does nothing, A, to benefit us holistically, and it does nothing to benefit the digital assets economy, because it once again just shows like sort of the downside of what this could be without proper controls. So that's kind of my perspective on that, is that isn't a unique argument to what's on chain. It's a holistic argument to how our country and our regulatory system works today, which
and
you
the
know,
crypto
like you and I
ecosystem.
we can go round and round on that one. Like,
Oh, I'll try to keep it brief because there are other topics I want to get to. But as a retort, right?
yeah.
If what we saw during the Gensler era and during like the 2021 run up, and what we're seeing with places like Robinhood and recent attempts at tokenizing securities, kind of skirting the law. Everyone's looking for a loophole that allows them to say like, oh, well, these are regulated. It comes with all these reporting requirements and blah blah blah. And we want to be able to do capital formation at global scale on chain because, profit, right? And so everyone's looking for a loophole to kind of bypass securities laws. And in the crypto industry, we've had food tokens and high inflationary things because it's only illegal to sell securities, not to mint them and give them away. So we had airdrops and meme coins and points and all these kind of like weird casino-y metas that have popped out as an attempt to avoid violating securities laws. And what we saw in 2021 was, well, sure, even 2017, sure, these things might be securities, but like this isn't a U.S. institution selling them. It's KuCoin in China or something, right? Or it's FTX and SBF that's based in, what was it, the Cayman Islands or something? It was somewhere definitely outside the U.S. And so when we added these frictions and people wanted access to the unregulated assets, all we were doing was creating a flight of capital out of U.S. control into less scrupulous hands like SBF. And that is kind of what I've seen happen in response to if you go too far on the regulatory apparatus and prevent people from doing what they think is in their best interests. So alternative approach to full mandate, these things are illegal and you just can't do it, is something closer like organic, right? You could have an SEC certified exchange like Fidelity, and it can only sell or deal in SEC certified assets. Kind of like if you have an organic, label on a piece of fruit, it has to follow certain rules in how it's grown. And then, put on your big boy pants and decide, are you a person that wants to be under that protective umbrella? Or are you a person that wants to accept the risks of the Wild West, right? But that the Wild West is going to be available. And if we try to corral people solely into the protective apparatus, one, it's a leaky bucket. The money will escape, and it's just going to escape into less scrupulous hands and generally treat those investors worse. So you're actually like the apparatus of Gary Gensler is actually doing investors harm because meme coins are way worse than just ICOs in terms of like honesty, transparency of what you're doing with the funds, and it basically led to innovations around the securities laws rather than innovations in the technology stack and the product level. Right?
But I think historically, the entire industry for a long time operated in the quote unquote gray because there wasn't clear parameters. And that did lead into a lot of regulation by enforcement because there wasn't clear swim lanes. See, I think a bit to your point, and people were looking for creative hedges around there. I do think in the market that we're in today, and in a post sort of SBF, FTX world, people are looking for clear parameters to credentialize the market and to make it more mainstream. And so I do think that although historically you were seeing a lot of flight from the US market, the goal of what we're doing today is to find that balance where we are having a level of protectionism, which we have across all facets, whether it's financial services, healthcare, et cetera, and being able to still offer products and services and innovate in a way that is exciting to the market. And I do think that that comes with a little bit of time and a little bit of patience, because I do think that things have shifted in this world. And yes, we want to see more things on chain, but we want to do it in a responsible manner. Because another blow up, people, individual retail investors losing their life savings isn't something anyone wants on a product they don't fully understand. And I think what we see every day is we see the propensity for fraud in this market and not having those correct controls. And, deep fakes are getting better, things are getting better, and you're watching the technology be utilized to exploit really populations at risk and people that don't have the depth and understanding but are being swindled. And so I don't think that helps anyone. So again, finding that sort of sweet spot, and I don't think we're there yet by any stretch of the imagination, but I don't want us to go too far afoul on either side of the barbell.
Oh yeah, well, I mean, no arguments that I would like even the crypto industry to do whatever we can to fight fraud and to give make people able to make an informed decision on the risks that they are taking, and how to do that without just causing a flight of capital like we've seen is an interesting question, right? Like, as you say, this is a negotiation. I don't think it's going to be solved this year in the next 23 minutes, but I want to pivot back to something that you were talking about before, which is interoperability.
Logri,
Yep.
real quick, I want to ask a couple questions.
Yeah, go ahead.
So first of all, I feel like history doesn't repeat, it rhymes. The 2008 financial crisis, exactly how many executives went to prison? I'll wait. And Caroline Ellison of FTX fame is now released. I mean, good God, man. All right. So going to lead bank, I just want to do a couple of like lead bank focused questions. Who can open an account? What is your focus as far as customers? And the other question is how has the reception been, and how does blockchain work into it?
So as I said, we bought the bank specifically to work with fintech and digital assets. So our customer acquisition is twofold. Obviously, we have a community bank here in Kansas City, 2 physical locations. You can walk in and open up a bank account with us. That's great.
Gotcha.
But what we focused on of building out as an infrastructure platform to be the underlying infrastructure under fintechs and digital assets. So for example, we are a banking partner to a firm originating buy now, pay later loans that a firm facilitates.
So is this like banking as a service then?
Yes.
Oh,
yeah.
neat.
So we're heavy in that. And then we started out, again, very slowly into digital assets to make sure we were taking a crawl, walk, run approach. So we initially started with, you are a digital assets company. The market for banking services was very challenging. You needed an operating account to put your equity capital, pay your bills. You needed an FBO account to hold customer funds. Now we see that there's a use case for international remittances. We're issuing a card in partnership with one of our digital assets partners that allows you to spend on a Visa prepaid access device directly out of your stablecoin wallet. We're now settling directly on chain those amounts 24/7 with Visa and USDC. So we are working to be the thought leader on this. And again, to one of the things we were talking about, do I think every financial institution out there needs to issue its own token? I absolutely do not. I think we're figuring out right now, you're seeing a whole lot of protocols, a whole lot of tokens, a whole lot of everything pop up. And one of the things we're trying to be incredibly scrupulous about is, what is the problem that we're solving? Like, there's FedNow, there's all these other rails. What do these on-chain rails unblock from treasury management, effective utilization of capital, reduction of risk, which I know when I say that about crypto, as a chief risk officer of a bank, everyone kind of pauses for a second. And I was like, to be clear, I can follow the money on chain in a way that like I can't do on the fiat side.
Right.
Like, I can get in there and link wallets and be a better partner. But so we are very much focused on what can be the utility function for what we're doing on chain. How can we work with our clients as an infrastructure provider? And how can we be sort of a bridge, no pun intended, between the digital assets ecosystem and traditional financial institutions? Because again, the last thing to what we were chatting about that we want to see is an offshore flight of capital. Like, that is the worst situation for everyone. And so we want to make sure that US banks are staying plugged in. That being said, I think for a long time, we weren't seeing a lot of banks that wanted to be in the sector. We saw a lot of scrutiny around it. We saw a lot of debanking of the digital assets industry. So making sure we're doing it in a responsible way is very much top of us. But you can get a bank account with us. You can get one through one of our third parties we work with. We might be your bank now. You just might not know it.
Excellent. I'm curious also, you're a New York girl, why Kansas City? And then the second part of that is, did you go to the Heartland Digital Asset Exchange back in September, October, the KC Digital Drive Group? Are you familiar with them?
I didn't go, but one of some of the folks on my team did go. And
I was there.
KC, I'll be honest, like pre-lead, I wasn't wasn't as familiar with it.
Yeah.
I'm originally from Chicago, so the accent will come out, especially if I have 1 to 2 tequila drinks.
Or
You'll start to get
if
more
we
of my
bring
south
up the
side.
topic of pizza, we're screwed.
Oh, if you wanna just see me cry, you talk about the Bears playoff game, and like that's just a whole
I
other
was
side
so
that I don't
rooting
want
for them, dude. We could go off on that quarterback. What a god dang
to.
legendary catch and pass that was. Holy shit.
Yeah. But Kansas City, we were looking for an institution to buy and we looked at a lot of different targets. And, this wasn't on our bingo card when we were looking. And we came and we met with the family that owned it here in KC, and they were fantastic. And there was just an openness to innovation that, again, with my co-founder Jackie, we looked at a lot of institutions where when the two of us walked in, I'm not going to lie to you guys, we got a little bit of, how are you girls going to afford this? To which I said, I have a 4 handle on my age.
Excuse me?
No one's called me a girl in a very long time. Let
At
me
the
tell
very
you.
least, lady. Thank you very much.
Yeah, but it was one of those things of finding something that fit us from an asset size, from, just a composition and from a team was something that was super important to us because we knew that we were on an uphill climb and we wanted people that wanted to be on the mountain with us. And so
Okay.
we're super, super happy. I've become a Chiefs fan. They're my second favorite team after the Bears.
Fair.
But it's a great city and
Okay.
I think everyone should visit it.
You came for the bank and stayed for the barbecue.
There you go. That's what I'm going to put on a t-shirt.
Real quick, and then Logri, I'll turn it back over to you. Caitlin Long, Custodia Bank up in Wyoming. I'm hoping that you've had a chance to talk with her. She's one of a kind. I got to meet her briefly, and I'm not going to flex. I got flown to London by Paul Brody from EY, and she was there, and I was just like, oh my gosh. Yeah, she's been great in the space.
Yep.
And as it relates to being, women in banking and this thing is just it's a movement, and I feel like there's a lot of women up at the top. Megan Knapp from Franklin Payroll is doing some amazing stuff on chain. I mean, honestly, I don't care who leads it. I think it's inspiring to anybody, and I'm just curious if you've crossed paths with her and what has been kind of this shift, because I think she's been trying to get a banking charter for years, and there's never been a banking charter given since like 2008, and it may just end up being like, I think she got it finally, and being a crypto native kind of a situation. A trailblazer is what comes to mind. What are your thoughts on Caitlin Long, the work she's been doing in Wyoming, and the broader regulatory body, and is it going to stay through the primaries, through the next election?
So I am not too proud to say that we are all standing on the shoulders of people like Caitlin that have been fighting the good fight for a long time, and I'm really nothing but respect and admiration there. I think it took a lot of muscle to get us as far as we've gotten. And I do think that at this point, crypto is not going away. It is more dangerous to allow these funds to be leaving the US borders than to create thoughtful regulation around it and try to retain it. And I do think that where we're landing, you're getting enough bipartisan support and buy-in, and you're seeing these use cases that really change it. Like everything we do is product driven. And I'll be honest with you, like I've been a skeptic. I was like, maybe it's a speculative asset. Maybe it's something I'll make money on. Like I'm a Wall Street girly at heart. But I think fundamentally now, you listen to the stories and the use cases. You look at the humanitarian use cases to get funds into places where you couldn't before and where US dollars are at a premium. You look at folks in the US who are trying to send money to their family and we're paying exorbitant rates and now can do it via stables. You put a card on that, you let them use it. Like there are so many use cases for what we're doing on chain that when you dig into it, it's ridiculous to think this is going anywhere and that you can go back to where we were probably a few years ago. You have to lean in, you have to regulate it, you have to be logical, and you have to find a way for the US to remain at the forefront of this and to continue to not penalize, but really incentivize folks to do the work. And so what Caitlin did in Wyoming, I think, was a great first step into what needs to be a much, much broader dialogue and discourse and get everyone on board. Because again, there's definitely cohorts of people there, but I tell everyone, like, even with stables, till I get like folks in Kansas City on a domestic use case wanting to pay their build and stables, maybe that's not a rail that makes sense to them. Maybe then we're talking about smart routing of money. Maybe for some geos and use cases, you're going to ACH. Some you're going to send a wire. Some you're going to use stable coins. Like, that should be a choice. It should be intelligent. We can find a better way to move money on a global basis. But I don't know that any one needs to be the be all and end all. So the question is, what can we do with these things that have such utility while still not letting bad actors into the space? So I think Caitlin's done a great job of sort of starting the dialogue.
Super quick. M-Pesa, is it M-Pesa, which is like, is that the African payment rail? I'm trying to remember. I think it just went to layer 2 on Ethereum, maybe. There's some of these things where it's like the money remittance and the micro loan type of things are really like you blinked your eyes, and in 3 years, trillions of US dollar denominated digital transactions have taken place, like the total amount of trillions of dollars, when like 3 or 4 years ago didn't happen. I think, to your point, when you're talking about Kansas City natives using, debit cards that are denominated in USDC, I'm wondering if you got to flip it around to where it's the retailers are saying, if you use USDC, we'll give you 1.5% off per transaction, just so we don't have to eat that 3% to Visa, MasterCard. And now you got an incentive structure for the customer to save 1.5%, and for the business to earn 1.5%. That's what it's like, that split. And I don't know, you just get them in the pocketbook like that. It's why kind of capitalism kind of works. If you can figure out a way, make sure Uncle Sam gets paid. I think they'll be, I don't know, we got a bright future.
Uncle Sam's going to benefit from the growth of stablecoins because it creates the demand for US Treasuries. And I want to talk about, there's this kind of pie of who benefits, right? So Uncle Sam benefits even though they're the ones paying out the interest because of the demand for the dollar and the soft power that creates. And the more people that want to hold treasuries, the lower the interest rates on the treasuries become, just supply-demand dynamics. But then you have issuers of stablecoins, which is like your Circle and Tether. And the way that the banking lobby seems to want, I'm not accusing Lead Bank of anything here, but the way the banking lobby seems to want this to go is, Circle and Tether have to keep all the interest. Otherwise, bank deposits won't be able to compete. And then, there will be all this flight of capital from banks, and there'll be a collapse of the credit institutions of the US, and that'll be bad for everyone. It's paraphrasing something you said before, right? But then we've got Coinbase offering 4%. Now, can you start by just summarizing how they're able to do that? And then how would that loophole be changed by what's been proposed with the Clarity Bill? Like, what is the dialogue happening from the banking lobby, and where do you think this is going over the next 6 months?
Yeah, and I think that is a big component of where everyone plays in the value chain, because again, it goes from the issuer to the exchange and who can actually offer these yield-like products. And again, just to be clear, you can have a yield-bearing stablecoin. It's just considered a security. Like, there is a regulatory framework, but to what you said earlier, people just don't like it. Like, that could exist today. It's just not something people want to use. And so that's point one. And I think point two is that right now, when you look at this quote unquote rewards loophole, and you see the banking lobby, and you also see the digital assets lobby is doing the same thing. And I think our perspective, at least my perspective, not speaking on behalf of Lead, but is that there has to be a balance in between those that makes it useful. And there's a lot of different ways and creative solutions that are around there. You're seeing folks start to talk about reserve capital relief potentially for banks, that we could hold the reserves and get some level of capital relief on it if you want to offer rewards on this and change the dynamic there. You also have to think about, when you think about quote unquote rewards, I think differently about money at rest, which Genius was very clear, money at rest, issuers cannot issue interest-like products on it, versus money in flight, where you think of credit card rewards. I think that's where right now everyone has their heels dug in quite robustly on the two ends of the barbell, versus trying to find that
there's a
middle
bunch
ground.
in the middle, though, right? So let's take I take my stablecoin USDC, I pair it with USDT, I put it on a Curve exchange, and now bribe rewards are being streamed to me. Is that at rest or is that in motion? Right, somewhere in the middle.
I don't know, honestly. Like,
right, exactly. It's somewhere in the middle. So,
yeah.
like when we say, okay, you can't pay people for holding a stablecoin, can you pay a moneymaker for like building liquidity for you? Is that a service fee? Can you pay someone for a credit card, like a reward program? Can you pay them for other services, like if they become a junior tranche that's insuring the larger system, right? We can imagine this kind of spectrum of services, and also, okay, the issuer can't pay you, but can the exchange pay you? How about the application? Can Curve pay me? How about the L2? Can we take some of the interest income from the treasury bills instead of going to Tether's market cap? Could we pay for the Ethereum Enterprise Alliance, or could we pay the Ethereum Foundation for developing Ethereum? Right? That's not going to the end holder, but it would still be I think it's impossible to ignore the value of the Ethereum chain if it's securing all the stable coins. It's impossible to ignore the value of the application layer if it's generating the demand for the market cap of all those stable coins. Shouldn't they get a cut, right? And if we could distribute that pie chart and take away from Tether's, potentially 90 billion of revenue a year for 150 people and distribute that more fairly to the chain of people adding value, you get a better ecosystem outcome.
So who's lobbying for that? Like, I guess that's the question I would throw back to you is like, in order to actually have the move from the issuers, the market makers, the exchanges, and the banks, like who's actually taking up that point of view?
Well, it's not going to be Circle and Tether because they're the ones that are going to benefit from saying, oh, well, the law says we have to keep the money. So, let's take our 90 billion a year and turn that into our market cap, right? So it's not going to be them. So it would have to be the DeFi ecosystem. It would have to be the applications. It would have to be the blockchain L1s would have to be the ones lobbying for that because they're the ones that would benefit from the redistribution of that pie chart to a more ecosystem-wide outcome.
Because honestly, I've heard a lot of the different arguments on all sides of this. No disrespect. I haven't heard anyone coming to the table from like the DeFis and the protocols to actually be making
you
that
should
argument.
Reach out to Etherealize because they are the ones that, according to themselves, should be representing that case.
Okay. I wanted to I don't fully disagree with what you're saying, to be honest. I just haven't actually seen that as in the conversation to date. And that's part of the rulemaking process. Like there's what's going to go into the bills, but then again, it's the same way where people will approach me and be like, we have a completely genius compliant offering. And I was like, no one has
what does that mean?
There's been no rulemaking. So that's a bit of a red herring where I'm like, no, that's not a thing. So I think in the rulemaking process, that's where we are now, is having this dialogue and these discussions. And I do think that everyone is trying to hold the entire pie, and I don't know that will work long term.
I am happy to come be part of the rulemaking process. If you want someone to come and represent that point of view, I am happy to come and do that. So you know how to reach me.
No one elected me to anything, so I just get to sit on here and chat about my ideas on this podcast and try to talk to the folks that the elected officials that are actually doing this work and try to bring
no elected officials asking my opinion, but
fair enough.
Not yet.
If you want me to be part of the rulemaking process, I got you, fam.
Yep, not yet, but we'll get you there.
You're going to be a political consultant in about 10 minutes. Like if there's any politicians that want to bend the ear of LogrisTheBard,
hey,
just go to
if you're listening,
explain.com.
Yeah, we're gonna make him put on a dust off whatever suit you've got in the closet and get up on the hill. Start taking meetings.
I look good. I look good when I suit up. All right. So I think that that is I don't think that the people that are making the rules understand the spread of the beneficiaries and who contributes to the growth of stablecoins and really understand like what an LP is in a market making system, right? I don't think that's part of the conversation, as you said. And it's a shame because it is likely that if you want to have the growth of stablecoins and you want those stablecoins to be liquid, and the way that we do that in DeFi is via basically rewards to place the money there, that we should take some of that interest from the treasury bills and use it to fund that, right? I think that's a natural way to promote the growth of a stablecoin, and it's for a service being provided, not just for money at rest, but the money is kind of at rest, if you know what I mean. It's just sitting in the pool, right?
I think it's whether or not, I think there's a big difference and differentiator between the investment in the system holistically versus the end user and what feels like a depository product versus a non-depository product, and who's allowed to,
Make
offer
that decision.
depository. Yeah. who's
be
allowed to
rulemaking.
offer depository products generally. And then that goes back to where we started with, you're probably, I believe nanny state is how you referred to it. I referred to it as consumer protection and making sure people understand. And there's rules to make sure that if you are going to put your money there, you understand all of these things. Because again, candidly, and this may sound blunt, like this is people's livelihood. It's very different than other sort of technologies that emerge that, although useful, I tell my tech team all the time, like we're building something for people's livelihood. This isn't, an appointments app. It's a very different, and there should be a higher bar and there should be higher scrutiny and there should be rules to be followed because that protects Americans and that protects people's money, which they've worked hard for. So I do feel strongly about that. I don't agree that everything should be sort of the Gensler era of like regulation by enforcement, but I do think we need parameters to live within.
I think that we definitely need options for people who want to live within those parameters, right? Regardless of whether I think we should force everyone into them, which is one end of the spectrum. I think that if someone wants to go and buy the organic fruit, that they should have the right to do that. If someone wants to say, I only want my money in an insured system, it should be clear that the money, that the system they're depositing into is insured. If they want to say, I want to ensure that the assets that I'm buying are all following reporting frameworks and things that disclose and make the asset transparent, that they, can enter into an exchange that ensures that for them, right? I guess I just disagree with we're going to compel everyone into a securities framework, no matter what they want to issue, which is we're both somewhere in the middle and just different points in that spectrum. I think we're just about the top of the hour. So JT, do you have any parting comments? And same to you, Erica.
Just real quick on all of that note. Corey Frayer was on Bankless. He was inside Gary Gensler's SEC, and I think there was a bit of levity in the conversation about the consumer protection side of what the SEC was trying to accomplish at that time. I am definitely not changing my opinion on Gary Gensler in general, but it was a very illuminating kind of talk, and I think everybody should listen to that particular episode. And Corey Frayer I've talked to him twice on email because I want to get him on our podcast too, because I think it's good to have a conversation with the devil every now and then.
We'll talk.
I know you're going to have a hell of a good time with him. But back to Erica, lead.bank is the website. Erica, if you can hang on after I stop this stream, I want to talk to you just for a little bit off of the stream. And what a pleasure meeting you today. And thanks so much for coming on our podcast, the EV Mavericks Doots podcast. This is number one for you. There will be more, I'm sure.
Thanks for having me.
All right. Well, thank you so much. Well, it's been a real pleasure. And thank you, LogrisTheBard, our technical interviewer, for helping us out today. Thank you for subbing and smashing and all those things. Go to dailydoots.com. You can subscribe to us wherever you get your podcasts. And tomorrow, we're talking to Nownish and Adrian from Farcaster. Good morning, Farcaster. They are the number one streaming podcast on Farcaster. And I can't wait to see those ladies again. They are leaders of their own kind for sure over there on Farcaster. And get on the website, dailydoots.com. We got 4 or 5 interviews. We're booking into February. If you know somebody wants a piece of this action, just send them my way. On behalf of the EV Mavericks Doots Live podcast, my name is JT. We'll see you tomorrow. Cheers and big hugs from Kansas City.